preserve their purchasing power. It's not so much as an investment or an investment gain, but just part of the battle is to keep what's $1 today, $1 tomorrow in this environment that we're going into.
Yeah, that's exactly right. You're preserving wealth when you own gold and when you own silver. And by preserving wealth, you have that wealth available for spending at some future date, spending or investing. We have these boom-bust cycles that are a function of the banking system and fractional reserve lending by the banks, where they lend out more money than they keep back in reserve. These boom-bust cycles are, a part of monetary history. We had the boom in the 20s. We had the bust in the 30s. We had the boom in the 50s and the 60s. We had the bust in the 70s. We had the boom in the 80s and 90s, and now we're going through the bust. And what the federal government is presently doing by trying to borrow more money to keep the bubble from deflating, keeping the bust from happening, is just going to prolong the problems that we're now experiencing. The country became too over-leveraged. Individuals, corporations borrow too much money. Banks loan too much money. In a bust, all of this has to come back down to hard, sound savings. Basically putting capital back to a normal level, bringing debt back to a normal level relative to the capital and savings of the country. And that's what the bust is all about. And I think we've got several more years, at least 2 to 3 more years of hard times before we finally reach bottom. And during this period of time, you want to protect yourself, protect your wealth, protect your purchasing power, and gold and silver are a great way to do that because you don't have counterparty risk.
We're covering this just a little bit, but this was from your recent piece, The Demand for Money. In fact, there is a pernicious factor at work here, namely the Federal Reserve and U.S. banking system are creating too many dollars. Because the quantity of dollars is growing more rapidly than demand, the dollar's purchasing power is being eroded in a process we call inflation. Going back to Economics 101, if supply grows more rapidly than demand, price falls, and purchasing power is the price of a dollar. These growth rates have increased the quantity of new currency over the past year far beyond the demand for new currency needed in commerce and are therefore inflationary. The dollar is being debased. The Federal Reserve is allowing the dollar's purchasing power to be inflated away. Own gold and or silver to protect yourself and your family from this ongoing erosion of what a dollar buys, end quote. But talk to listeners about this debasement that you explain in your piece, The Demand for Money, because some of the deflationists are saying, well, there's this creation of money, but then there's this wealth destruction, and the creation of money isn't necessarily outpacing the destruction of wealth or paper wealth. Or can you just address that for a minute?
Yeah. First of all, when you talk about wealth in the big picture point of view, there are really 2 types of wealth. There are real assets, real goods and services, and then there's paper wealth, financial assets. And during the boom, the quantity of financial assets grow to be quite large, and it looks like people are wealthy, but it's really just the illusions of prosperity, because real wealth comes from being able to consume things and use things, real tangible assets. So what we've been going through in this present bust is a lot of the paper wealth that was created, the illusions of prosperity that came about because of bank credit expansion. That wealth is never really true wealth in the first sense, in the real sense, and it's just evaporating and disappearing. At the same time, the money supply is continuing to grow, and we're measuring the decline in housing prices in Stockton, California, with a currency that's being ever inflated. So you have to distinguish between the destruction of wealth and the decline in prices of overvalued assets, and measuring the prices of the decline in those overvalued assets with a currency that's being ever inflated. The CPI is always going up, the PPI is always going up, and those numbers understate the true rate of inflation, the true loss of purchasing power of the dollar. So you have wealth destruction, but you have inflation. It's sort of an unusual set of circumstances. But if you look at countries that are on the road to hyperinflation, you see this in other places as well.
John and I covered so much from the book you co-authored together, The Collapse of the Dollar, and I don't want to give away too much from the book, but you did cover your well-known fear index, which has been around for quite some time. But the first time that I saw this, and I think it was in 2002, it showed the dominance of the paper markets for a couple of decades, at least at that time or by that time, and you were anticipating a crossover of the sloping downtrend line, which had been in effect for so long. That did happen, and it began a new cycle of fear in paper assets. We certainly have had tremendous fear of paper assets, and that fear has sort of of subsided a bit here recently, but are we in for more of an acceleration of fear and paper assets in the future, James? And obviously it sounds like you're saying that.
Yeah, I think we are. The economy is still in tough times. The unemployment rate is going to continue to grow, and you can't really expect the economy to turn around until unemployment starts declining, and I don't see any prospects of that for the near future. We still have another shoe to drop with the commercial real estate sector. Only now is that really starting to weaken, and we're starting to see some major price drops. That means another round of losses for the banking system. So the banks aren't out of this. I think it's the depression that we're in, really, given the high rate of unemployment and all of the other problems that we're experiencing. The banks aren't out of this. And just like the 1930s had a double dip in 1937, although it was bad last year, I think we can expect another double dip as the commercial real estate problems come to the fore. That will probably happen within the next 6 to 12 months.
You use the word depression to describe what we're in, and I asked another guest this, but you don't really repeal the laws of economic cycles, and it certainly seems that the U.S. or that the globe was headed for a depression, and that was averted through some monetary stimulus globally. But California, as you know, just slashed $19 billion off of its budget, and presumably there will be more over time. But as you set that trend nationally and you begin to see these states all begin to ratchet down and take billions and billions or hundreds of billions away from their budgets, it's odd to me that people would look into the future and see green shoots or see a longer-term economic recovery in that environment. I guess that's strange to me. What are your thoughts on the budgets and the decrease, or have you looked at that, James, and what impact that will have on GDP or the U.S. economy going forward? Because certainly it'll be very penalizing, will it not?
Yeah, it really is. GDP is declining year on year, and the only reason why it's not declining more is simply because of the federal government trying to stimulate things. But, when you're trying to stimulate things by borrowing and creating more currency, you're ultimately destroying the currency. And that's why I believe we're on this road to hyperinflation, that ultimately the U.S. dollar is going to be destroyed. And we're probably not too far away from that. It's been my view that by the end of this year, first quarter of 2010, the writing is going to be on the wall. So I think you're going to have some very dramatic markets in the next 6 to 12 months.
Before we go any further on the U.S. dollar, when you look at the euro as an example, obviously they have their problems over there. Some of the countries, such as Italy and some of the other ones, have had very serious budget problems. Is that a currency that can be counted on going forward, or can that fracture like people have suggested, the whole Eurozone region? What do you see dangers over there for people who are in euros, James?
Yeah, absolutely. The other reason why the euro has been strong is people have been exiting the dollar. It's a knee-jerk reaction when you pull money out of the dollar, out of dollars. Where are you going to put it? You're going to put some in euros. You're going to put some in commodity stocks, which is why commodity stocks have been doing so well this year. Again, it's another early sign of the road to hyperinflation. But when you look at the euro, it's really no different than the dollar. And in fact, the reserves of the European central banks, while they have some gold, it's also basically dollars. So that's the point I was making. If the dollar goes in a black hole, the gravitational pull will pull other fiat currencies with it. We have to remember this is the first time in the history of the world that the world's reserve currency was fiat currency. And no fiat currency has ever survived because ultimately, governments borrow too much and spend too much, and that's turned into currency. And that's the road that we're on. You can look at one country like an Argentina or Brazil or Weimar Germany or Zimbabwe and see the impact of that hyperinflation. But imagine the world's reserve currency hyperinflating. It's impossible to predict what the outcome is going to be, but it surely isn't going to be a very nice one.
Let's talk about silver for a minute and where you see silver headed, because obviously if you're going into a hyperinflation, it's very difficult to quantify it in terms of units of paper, but it does appear cheap versus gold. It does appear cheap versus maybe oil. Can you talk a little bit about silver and the fact that the governments, I guess, globally really don't have giant hoards of silver anymore, and that it has become somewhat rare in terms of above-ground supply?
Yeah, that's right. As bullish as I am on gold, I'm even more bullish on silver. And I do think that eventually the gold-silver ratio, in other words, how many ounces of silver it takes to buy an ounce of gold, will go back to the 15-16 historical average, which was the same level it was in January of 1980. And, right now we're about 60 667 ounces of silver to buy an ounce of gold. So you're going to see significant outperformance by silver compared to gold over that period of time.